When you buy a fund, you have to pay fees. And when you pay fees, you expect to get a service in return. Now, sometimes fund managers don't provide that service. So it's really refreshing when you see a company like Orbis, which actually refunds you if they fail to beat their benchmark. So here's my interview with Dan Brocklebank. It's the second one we've done. And I hope you can see the value of having such transparency in their fee, but also the value of being repaid your fee if they don't manage to beat their benchmark. So here's Dan explaining everything in his own words. Let me introduce Dan Brocklebank, who's UK Director and Head of UK Business for Orbis. And we first spoke last year when one of my clients told me about this incredible fee structure that you had. But I understand that you've been around for a very long time. And previously, you only offered a product to high net worth investors, but also institutional investors, so very, very large investors. So maybe you could tell us a little bit about that transition, Dan.
Sure. Good morning, Ramin, and thanks for having me back. I can't believe it's been a year since we first spoke. Orbis Investments, very simply, was founded in 1989. Our sister company was founded in 1973. So we've been around for decades through many market cycles. And we've had the same investment philosophy throughout both of our firms. So it's really been tested through some cycles. As you suggested, when we were founded, we were initially set up, and for practical reasons, really, we could only offer our services to people who had a large amount of money to invest with us. But over the last decade or so, we invested a lot of money in basically building the technology to lower our minimum investment. And we wanted to do something that would be available to as many people as possible. So we took our minimum investment all the way down to £1 for UK investors. And so we offer really our core services, which are a global equity fund and a global balanced fund. So it's a mixture of equities and bonds. And we offer them in the UK to investors from £1 minimum and through ISA products, JISA products, and just in ordinary investment accounts.
Now, I can superimpose the graph of your performance history when you used to be an investor only for very large institutional funds. And the performance was incredibly good over the very long term and through those market cycles. So perhaps you could talk about the fee structure in a bit more detail, because that's what first drew my attention to Orbis. And I think it really is very radical compared to other fund managers. So could you just talk briefly about that?
So our approach at Orbis has always been one where we think our fees, we're not trying to be the cheapest. We think our fees should reflect the value that we are adding on behalf of our clients. And when we launched a fund for UK investors, we tried to do something that would take what we would be doing for institutional clients, very large clients, one step further. And what we wanted to do was to offer a fee structure which had no base fee. So if all we do is perform in line with the market, we will actually charge no fees whatsoever. In fact, as a result of that, we'll be cheaper than a passive or tracker fund, because even those funds, while they're very cheap, they still charge a fee for their services. In exchange for that, we charge a performance fee, which is based on how well we have done for clients over time. And that performance fee is calculated as 50% of the outperformance relative to the benchmark. But that performance fee is not paid to us straight away. And this is a critical innovation. That performance fee is put into a reserve, and that reserve sits in between us and the client. And what it means is that if we subsequently underperform, performance fees that have been paid can be refunded back to the clients. In other words, what we're trying to do is make sure that the cumulative performance that we have generated for clients is the basis for which we have charged fees. So net, over the length of time that clients are invested, we're trying to align the fees that they have paid with the value that we've added on their behalf.
And if people don't realize that's radical, let me just say that is very radical, because I understand that recently you had a bad patch. Every fund manager goes through it, and you've actually refunded your clients some of the fee. Is that correct?
Absolutely. So as investors, we are what's referred to as very active investors. So our portfolios are not built by starting with the benchmark and then tweaking the position size a little bit. We go out around the world we've got teams literally around the world, and they're looking for mispricings, a relatively small number of mispricings in the world. And we build our portfolios from the bottom up by finding the best opportunities that we can find. As a result, our portfolios are very different to stock market averages or the benchmark. And inevitably, if you're different to the benchmark, at times you're going to perform very differently. Now, in 2016 and 2017, we had years when performance was significantly ahead of the benchmark. But so far in 2018, the opposite has happened and we have lagged. And as a result of that, because of our unique refundable fee structure, it means that the performance fees paid in 2016, but particularly in 2017, have been flowing back to the clients in the form of a refund. And that has softened the underperformance that clients have experienced. Obviously, while it's nice to pay a refund for clients, or nice to receive a refund for clients, it would be better if we were continuing to outperform and charge performance fees. But this structure makes it easier for clients to remain invested through the inevitable periods of underperformance that have always come along and will continue to come along in the future.
That is astonishing. And I think that's great. I mean, a lot of people think I'm against having active funds, but in fact, I think active funds are fine as long as there's a kind of fair fee structure. And one of the points you've made in the past, which I love, is how your fee structure aligns your interests with that of your clients. Could you just briefly explain what you mean by that? Because you always put it so eloquently.
Sure. Oh, well, thank you. At the heart of the belief is that ultimately, at the end of the day, incentives are very powerful at driving human behavior. In the majority of the fund management industry, the fees that a fund management company receives, are calculated based on the total assets under management of that firm. So it might be 1% or 0.5%. But the biggest determinant of the revenues of that company will be the size of that company. And when that's the case, and assuming you probably can't change your cost structure too much, if that's the case, the overwhelming incentive becomes to get bigger. And if you want to get bigger as a firm, you might do different things if you're just focused on maximizing the performance of your portfolios. We've taken, our approach has always been about maximizing the long-term sustainable performance of our funds. Partly, certainly not least, because we're all invested in the funds ourselves. So we really want to make sure that the performance is as good as possible. And that's ultimately what we believe clients want at the end of the day. So our fee structures have been set up so that we can only do well as a firm if the portfolios do well on behalf of clients. And actually, the interesting dynamic in the fee debate at the moment is everyone says we want fees. The big debate is that we want investment management fees to be as low as possible. Well, our clients should actually be wanting our fees to be as high as possible, because they can only be high when our performance has been really good. And ultimately, at the end of the day, I think most people intuitively get the idea of value for money. They don't mind paying a higher fee if they've received a great experience.
Now, one of the largest fund managers that there is the GPIF fund in Japan. And in fact, I think I found out because you tweeted about it, they've just introduced a fee structure which is similar to yours because it's dependent on performance. And I think other fund managers have followed suit as well. So would you like to just briefly chat about GPIF and why you think this is happening in the industry at the moment? Is it driven by investors or is it driven by fund managers?
Sure. I do think GPIF's move is significant. They are, for people who don't know, it's the government pension scheme, government worker pension scheme, and they are huge. I think it's well over £1 trillion sterling in assets under management. And in a nutshell, they've said to their active managers, we're only going to guarantee or pay you a base fee equivalent to what we would be paying a passive manager for the same mandate. In exchange for lowering that fixed fee, we'll pay you a performance fee based on how well you do relative to the benchmark, But that performance fee will be subject to a deferral mechanism such that it gets kind of recalculated and held back. And they, like our fee structures attempts to do, what they're doing is trying to make sure that the total performance fees paid are in line with the total performance received by them as manager. So directionally, they're very much moving in this direction. Other managers have also introduced performance-related fees. They are typically come under the umbrella of fulcrum fees. And I think in general, anything that tries to align fees with performance should be applauded and recognized, in my view. I think the fact that there are some very big names in the industry introducing these sorts of fees shows how important this issue and how material this trend is. But the sort of questions investors need to think about when they're looking at fee structures are just what fees will you pay if the manager just performs in line with the benchmark? And then what's the maximum that the manager might get paid and the minimum that the manager might get paid, and what sort of performance levels do they need to achieve to reach that maximum and the minimum? So those are the questions to ask. But I think it's being driven both by clients shifting to passive funds and saying, look, if I'm going to invest with you as an active manager, you've got to prove yourself, and I'm happy to pay you a higher fee, but only if you deserve it.
So perhaps we could talk about how you actually distribute your product. Is it very difficult to actually make people aware of it, and also maybe even to educate investment advisors about it?
Sure. So it's quite humbling, actually. We had been in existence as a firm, I think, for the best part of a quarter of a century. And over that time, I think we'd outperformed markets by 4% per annum. So it made a meaningful difference for our clients over that time period. But understandably, when people choose to entrust their money with somebody, it takes a bit of time for them to know the company and to get to know the company before they're willing to do that. So when we first started really meaningfully engaging with the UK market, first of all, we had to set up a legal vehicle that was appropriate for the market, and that's known as an OIC, an open-ended investment company. So we had to set that up as a specialist way to access our global equity and global balance strategies. But even then, we had to get those funds available in the way that people invest. But actually, the first thing we did is we made it available to people who want to come to us directly. But because we weren't that well known in the UK, that was not something that a huge number of people took up. So we started working firstly with platforms that people would use either through their advisor and then through platforms that people would invest directly. So it does take time. The reality is that there are lots and lots of funds being launched out there. Many of them are trying to get on these sort of supermarket shelves of funds. And so I think while I would have loved if we could have done it quicker and it not taken so long, the reality is it's competitive out there, and it takes a bit of time. The good news is that we've pretty much cracked most of the platforms. There's still a few that we're not available on. But one of the things that your viewers or your listeners just perhaps should make clear is that we don't offer special terms for clients who come through any different platforms. I think the industry is confusing enough as it is without people offering different fee structures depending on which platform you come through. So our investors can always know that while we're available on platforms, if you come through an IFA or if you come through your SIP provider, for example, if you come to us directly, that is the lowest fee. That you'll always be investing at the lowest fee rate possible.
It's interesting. One of my clients was telling me that they'd rather pay the fees to the fund manager rather than the platform.
Just to add there, we don't. If people do come to us directly and use us as a surrogate platform, we don't charge any fees for that service. So we have no platform fees and no transaction costs. The only fee and all of the ongoing charges of the fund are charges that we cover as the manager. We don't pass them on to clients. So the only fee that clients will pay for us in the UK is the performance fee.
So what happens if you don't offer a discount on some of these platforms? Is it impossible to distribute by their platform if you don't offer that discount?
I don't know if it's impossible. Time will tell.
Okay. And one of the things I've seen that you do, which is quite different from some other fund managers, is you actually roll out your fund managers, the people who actually run the money, you kind of drag them away from their Bloomberg terminal and you put them in front of the camera and they explain what's going on and their thought processes. And you're also trying to educate investors about your investment process. I think that's great because it's so transparent to see the actual fund manager, to hear your thought processes. Is that a deliberate move on your part to try and educate investors?
So I think if you step back, our view is that the industry typically does a very good job of making something which at the end of the day is relatively simple, but taking that and making it incredibly complicated. And the best investment advice that you can get is typically very common sense advice. You've got to be patient. You've got to have a long-term horizon. Unfortunately, with investing, and this is probably the tricky one, the best investment areas are, or the best source of investment ideas is often unpopular areas. And so those sorts of things, while everyone nods when you say it to them, are not always the easiest message for us humans to absorb and to act on, because we're sort of wired to have with an impulse to act and transact a lot, and our fight or flight instinct means that we like to run away from areas that might be causing us pain, and financial loss triggers the same response in the brain as physical pain. So evolution, from an evolutionary perspective, we're not very well suited to investing. We like the comfort of crowds, and that can be a disaster from an investment perspective. So our view has been that investing is not rocket science, and it's with some relatively simple tips, people can help themselves by an enormous amount. As a fund manager, we hope to add lots of value to our clients, but at the end of the day, their behavior will make at least as much difference as we're able to do on their behalf. For example, one of the biggest tendencies of retail investors is to see what has performed well over the last 5 years or so, and then charge into it and throw more money at it. And conversely, when something's not doing well, or when it's underperforming, they tend to capitulate and sell. And unfortunately, with investing, it's normally the opposite that is the best strategy. And so our view is that by trying to help people understand this, we might help them through their investment journey, and ultimately give them the opportunity to have the best chances of meeting their financial needs over the very long term. And that's kind of what our fee structure does as well, by taking charging a fee when we're doing really well and putting it in a reserve such that it can refund when we're underperforming. It softens out the peaks and the valleys of our performance profile, hopefully making it easier for our clients to remain invested with us through the cycle.
One of the things I found fascinating last time we talked was the way you approach the selection of people who do the actual fund management. So instead of going for star fund managers, you always want to make sure you've got the next crop of good fund managers on the bench ready to take over.
So perhaps, two things. I call it the Tiger Woods versus sort of Barcelona Football Club analogy. I know you love a good analogy, Raman. So with Tiger Woods, absolutely brilliant at the peak of his game, but nobody knew when it was all going to go wrong. And I think in the fund management industry, it can be very attractive to have a figurehead at the top of the organization, because it makes it easier for the set. I think having one individual does make it easier for people to trust that firm, but it gives the sales force something to hang their hats on. The challenge for clients is that the career span of a star fund manager is probably, or almost certainly, going to be shorter than their investing horizon. And really what you want when you find an investment manager is a process that you can rely on to be and to remain invested with them for 10, 20, 30 years. And so we see our goal, first and foremost, as providing good investment performance to our existing clients, But then it's investing in identifying the next generation of fund managers to take over from the existing portfolio managers as and when if they retire or whatever. And so we have a team. I think it's at least 40 people in our investment team at the moment. 5 of them drive the global equity strategy at the moment, but there are plenty of hungry people who are looking to prove themselves and earn a spot on that team bench in future. The other way to understand our investment, so that's how we manage the actual portfolio construction process. The other way to understand how we put the portfolio together in terms of our approach to picking stocks is to use a fishing analogy. And if you think of passive investors or tracker funds, they're like people who go fishing with a trawler and a great big net, and they just take a little bit of everything and haul it up. Our approach is to go fishing with a hook, and we're looking for a relatively small number of the best investment ideas that we can identify from around the world and use those to build our portfolios on a bottom-up basis. Fundamentally, what we pay attention to is the value that we're buying. And if we can buy dollar bills for significantly less than $1, then we think that's the best approach to generating great investment performance over long periods of time with a lower risk of loss. Ultimately, at the end of the day, value matters above everything.
Brilliant. Okay, thank you very much, Dan, and hopefully we'll speak again soon.
Cheers.
And so more money managers are moving towards this model where they get paid less fee if they don't manage to beat their benchmark. And that just seems to be more of a fair deal for investors. And it's driven by the move towards passive investment. Active managers just have to do this in order to keep their customers. So I hope you found that interesting. Many of you tell us that you do find these videos interesting. And if, like Kishore Bhagwat or Robert Bradbury or Ian Stenton, you pay us $10 or more a month on Patreon, you get your name called out at the end of the video, but also you get extra features as a member of our community. You also get to take part in our live Q&A session if you pay us $5 or more on Patreon. It's easy to do, just click on the buttons at the top of the page. And you can always subscribe to our channel if you don't want to miss any new videos. And as always, thank you for listening.